Let's imagine that you own your own business, and you want to sell a part of that business to other people to raise money and bring on more talent. If you are a sole proprietorship, that would be impossible, because a sole proprietorship business and the owner are the same entity. You would essentially be selling pieces of yourself. If you wanted to sell parts of your business to other people, you would need to separate the business and the owner first. That's what a corporation is for. A corporation is a business that is its own legal entity, separate from its owners. This allows the owners to sell the business to other people to raise money instead of taking out loans. Most people couldn't afford multi-million-dollar businesses, so the owners typically break the business up into smaller pieces of ownership that they can sell for smaller amounts of money in larger quantities. These small pieces of ownership in the company are known collectively as stocks. A single piece of stock is called a share of stock. Many businesses sell their shares of stock to the general public in open markets known as stock exchanges. One of the most famous is the New York Stock Exchange in New York City. When you purchase stocks in a company like Apple or Coca-Cola, you become an owner of a small percentage of that company. The owners of the company are known as shareholders or stockholders because they hold a number of shares of stock in the company. In a sole proprietorship, the owner of the company makes all of the management decisions, but in a corporation, that becomes more difficult. A large corporation could have hundreds or thousands of owners, or stockholders, and getting them all together to make management decisions would be complicated and unproductive. Instead, the shareholders vote on a group of individuals who represent them and their interests, much like a Congress is elected to represent voters in their state and federal governments. This group of elected officials are known as directors. Collectively, they are called the Board of Directors. The Board of Directors oversees the finances of the company and supervises the work of the executive management team. Because the structure of a corporation is different, and the owners interact differently with the business, the equity section of a corporation is a little different too. The first major difference is the name. Instead of owner's equity, it is now called stockholders' equity, since the stockholders are the owners. The name of owner's capital also changes in a corporation. In a sole proprietorship, an owner invests money into their business by depositing cash, which increases capital. In a corporation, an owner invests money by purchasing more stock. So the capital account in a corporation is known as capital stock. Unlike a sole proprietorship, the capital stock account in a corporation holds only the value of the stocks that are purchased. Any net income or dividends are not closed to capital stock at the end of the fiscal year. Instead, these accounts are closed to a new account called retained earnings. It's called retained earnings because this account is where any excess earnings not taken by owners are retained in the business for the business to reinvest into future years. We will learn more about retained earnings later on in this course. The owner's draws account also changes. In a corporation, draws are called dividends. Because corporations have many owners, there are special rules surrounding how dividends are used and how owners can take money out. But we will talk about those later on in this course too. For now, it's important to know the new terminology in the equity accounts for corporations. Owner's equity is called stockholders' equity, capital is called capital stock, and draws is called dividends. And we have that new account called retained earnings that will get used for closing entries. To learn more about corporations, equity, and other accounting topics, check out more of my videos on YouTube or visit torinorman.com.